Hey, welcome back to your favorite Fundamentals of College math class. We're going to look at annuities, methods of saving, and some investments vocabulary. Here's our objectives. Let's talk about what an annuity is. That's when you make a sequence of equal payments. So up to this point, what we've done is we've just put in a principal amount. We let the money sit there, gaining interest, compound interest over time. This situation is we're putting, at least in this section, we're not putting any money in up front, but we're making some payments over time. And then we're going to see what the value of that so-called annuity is at the end of a time period. So here's an example that kind of gets you a feel for what an annuity is. You deposit $1,000 at the end of each year for 3 years. Okay, so at the end of the year. So the interest rate's 8% per year compounded annually. So what's the value of the annuity? Well, let's do at the end of year 1. At the end, you deposit the $1,000. So there's your deposit. You gain no interest because you did at the end of year 1. At the end of year 2, you have that $1,000 from the last end of the year plus your interest, which would be you're making 8% on that $1,000 the whole year. So 1,000 times 0.08, so 80 bucks. Plus, now you make your payment at the end of the year, 1,000. So you got 1,000 plus 80 bucks plus 1,000. We got 2,080 bucks at the end of year 2. Now we're doing this for 3 years. So at the end of year 3, so we have the $2,080 from the end of last year. Now we're going to gain interest on that. So 8% on 2,080. And then we make our payment at the end. So here's our interest. Here's our payment at the end of the year. And this ends up being 3246.40. So that's the value of the annuity at the end of 3 years. Okay, so that's part A. Here's all part A. That's the value. We get $3,246. Part B says, well, what's your interest? Well, the interest on this is the value of the annuity minus all the payments that we made. All the payments. So the value at the end of 3 years, we have $3,246.40. But we made 3 payments of $1,000, right? At the end of each year, we paid $1,000. We got to subtract 3,000 from that because we put the $3,000 in. So the interest in this case is only $246.40. Again, because we made 3 payments for $1,000, right? So that's the free money there. What's the free money? The interest, $246.40. So that's how an annuity works. Now, luckily, we have, this is just the same thing we just did. We do have a formula. It's a lot more complicated than the last, or it's a little more complicated than the last one. But this is a formula and how your authors have that in the textbook. Now, what drives me nuts is this P here. Most textbooks will use that as a PMT. Okay, so don't confuse that. That is not the principal you're putting in up front. This is a different formula. That P is the payment. So in the case of what we just did, and our R is our interest rate, R is the interest rate, N is the compoundings per year still. So the N is still the compoundings. R is the interest rate, is a decimal. N is N compoundings per year. T is our time in years. Okay. So in the case of the last one, if you were to use this formula, you'd say, well, I'm making a payment of $1,000 and I make 10, let's see, no, we made 8% on that, so 0.08, and it was compounded annually. I need to give you that information. In that case, it was compounded annually, so your N is 1. And then up here you have 1 for your N. You're doing this for 3 years. And then subtract 1, and and then all divided by 0.08, and it's compounded annually. Okay, and once you work this out, so you got 1,000. Yeah, 0.08 divided by 1 is just 0.08, so you got 1 plus 0.08, so 1.08. 1 times there's 3, and then you can take that value, subtract it from 1. On the bottom here, 0.08 divided by 1 is just 0.08. So I punch in 1.08 to the third, and I get 1.259712, blah, 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 minus 1. So now I got 1,000 times 0.259. Again, don't round this. This keeps going. Don't round until the very end. So this is 259.712 divided by 0.08. We got the 3246.4. Okay. Just like this one here. We had the, whoops, where is it? The 3246.4, right? So same thing, you can use that formula now. Let's do another one with the formula. Say for retirement, you decide to deposit $1,000 into an IRA at the end of each year for the next 30 years. You can count on interest rate of 10% per year compounded annually. So our N is 1, compounded annually. How much will you have in the IRA after 30 years? So count is the P. Again, this is your payment. I'm going to change that to PMT. 1 plus R over N to the NT minus 1 all over R over N. All right, so we're paying $1,000 at the end of every year. This is compounded annually. Our interest rate's 10% compounded annually, so we got a 1 right there. If this was monthly, I'd put a 12 right there. Annually, put a 1 right there. Time, we're doing this for 30 years, T. 10% annually. So this is 1,000. I got 0.1 divided by 1 is 0.1, so 1 plus 0.1. I got 1.1 to the 30th. So I take 1.1 to the 30th is 17.4494, anyway, minus 1. So I got 16.4494, times the 1,000. So I got 164,449.4 divided by 0.1, and this finally equals 164,494.02. So 164,494.02. That's the value of that thing at the end. Okay. Now part B, the interest. The interest is the value of the annuity. So I end up with this much money, but I made all these payments. How many payments did I make? I made it every year. So I did it 30 times, 30 years. Every year I paid 1,000. So 30 payments I made of $1,000. So I got to subtract 30,000 from 164,494.02. So I get 134,494.02. That's how much interest was made. I only invested $30,000 myself over that time period. 134,494.02 is free money. Free money. Okay. So here it is, walkthrough written out there, rounded answer on that. 0.02. Make sure, again, don't round it until the very end, or else you're going to have rounding error. All right. Now, I'm going to be using this financial calculator that I showed you guys in that last section. So I'll pull that up here in a minute. But let's talk through it here. With your financial calculator, fncalculator.com, the present value is the principal. We're not putting any money in up front. We are making $1,000 payment every year. We want to know how much we have at the end. So I'm going to click the future value button. I'm making 10%. That does not go in as a decimal like with the formula. This goes in as 10%. That's as a percent there. Periods. This is N times T. This is compounding annually, so it's only 1 times 30. If this was monthly, it'd be 12 times 30, 360. In this case, it's 1 times 30. There's only 30 periods. You're making 30 payments, once per year for 30 years. Compounding annually. I also want to make sure you know the mode here is at the end of each year. You do that. So let me pull up the calculator here. I'll show you that. Time value money calculator. So again, fncalculator.com. Click on time value money calculator. We put zero money in up front. Notice the mode is end here. Okay, putting the money in at the end. Our payment is $1,000. I'm going to solve for the future value. I'm making 10% on this. N times T annually. 1 times 30 is 30. This is annually. The future value we have, there it is. 100, again, ignore the negative sign. That just means you can withdraw all that money. 164,494.02. 164,494.02. See how nice that is? That financial calculator. As long as you get that in right, okay, you can work these real easily. All right, let's do a different one now. These 5 save for retirement side. Deposit $200 into an IRA at the end of each month at an interest rate of 7.5% per year, compounded monthly. How much will you have from the IRA when you retire at age 65? Okay. Well, first of all, before I do the financial calculator, I'll give you at least the setup for those that want to do the formulas. I know there are some of you that do like the formulas. So if you're doing it with the formula, you'd say the amount I have at the end is your payment, capital P, 1 plus R over N to the N, T plus 1 all over R over N. Okay, so this is, you're making a $200 payment every month, okay? This is compounded monthly. Your interest rate is 0.075. This is monthly, so your N is 12, N is 12. You're doing this from age 25 to 65, so that's 40 years. So your T is 40 here. Your R 0.075 divided by N. Again, this is a monthly compound. Okay, let's do it with the financial calculator. You're putting no money in up front. You're making a monthly payment of $200. I want to know my future value. My rate is 7.5%. The periods, again, remember this is N times T, monthly compound times 40 years. 12 times 40, 480. I'm making 480 payments because I'm doing it for 40 years, 12 times a year. Okay, so 480 is my periods on this. My compound is monthly compound. Keep it mode end. And this end of the month. Just when this thing is figured, and I'm going to click on future value there. Okay. Let's go ahead and pull up. So 0 up front, $200 payment. I don't know this yet. Let me just reset it. Okay, 0 up front, mode end. I'm making a $200 payment. My interest rate is 7.5%. I'm doing this for 40 years, 12 times a year, 480. My monthly compound. Click the future value 604,764.43. 764.43. Yeah, so that's how much money you have. 604,764.43. The second part says, well, how much of that is interest? Well, we ended up with 604,764.43. But I made 480 payments of $200, which is $96,000 in payments, right? I made $200 every month for 40 years, 480 times I made that $200 payment. So 604,764.43 minus 96,000 is 508,764.43. Okay? There it is. I just round that. This is rounded up, by the way. It was 604,764.43. If you ever hear, sometimes in the questions they'll say round up to the nearest dollar. This kind of drives me nuts, but there's nothing I could do to change it. If they say round up, even though I know you're thinking, well, by the rounding rules, I should round that, I should leave that at 4, right? But if it says round up, it doesn't matter. You just round it up, regardless of what's in that position as you're thinking about rounding it to the nearest dollar, right? So this would round up, round up regardless if it said round up, okay? And the reason they do that, by the way, is like sometimes they'll say you'll be figuring out like a payment that you need to make, and you need to make a payment of, let's say, $200.05 to reach some financial goal. Well, if you don't round that, if you're going to pay to the nearest dollar, if you only pay 200, you won't reach your financial goal. If you round up to your nearest dollar to make a $201 payment, you'll reach your financial goal and actually exceed it just a touch, right? So that's where the round up and practicality comes into play. All right, so here's a formula. Again, we're going to use a financial calculator. This is the formula to find the payment that you need to make to reach a financial goal for a value A in dollars that you want to reach, okay? So suppose you complete your college education, begin working, you would like to save $20,000 over 5 years to use as a down payment on home. You anticipate making regular end of the month deposits and an annuity that pays 6% compounded monthly. So there's no upfront principal. You're making a payment and you're trying to figure out how much the payment should be, but we want to end up with $20,000 at the end. Okay. Your rate that says you can plan on is 6%. The periods, and notice this is compounded monthly. We're making these monthly payments. So again, this is N times T. Monthly payments, 5 years. 12 times 5, we have 60 payments that we're making. So that's our periods. Again, compounded monthly. Our mode here, by the way, 95% of the time your mode is going to be on end, unless they specifically say at the beginning of the month, then you would change your mode. But anytime you're using a financial calculator in everyday situations with loans, um, all that, mortgages, auto loans, whatever it is, I've known, annuities, you're going to be using the end mode unless it specifically says otherwise. There might be one or two questions that they'll say mode would be end, beginning of the month. Okay, so we go ahead and let's put that in. See what our payment's got to be here. Reset this. I'm putting no money in up front. I'm trying to figure out my payment. I want to end up with $20,000. My rate is 6%. I'm doing this for 5 years, 12 times per year, so 5 times 1260. Monthly, my mode is end. Let's click on the payment, 286.66. 286.66. Oops. All right, so we got to make, if we're going to round to the nearest dollar, 287. Yeah, we can't pay 286 because we won't reach our $20,000 goal. So we got to round up on this if we're going to round to the nearest dollar. 287. So we got to make 287 a month, and then we'll definitely reach our 20,000. In fact, we'll surpass it a little bit, right? All right, so how much of this was free money? How much of this was just purely interest, right? If we're going to make, so part B here, our interest, if we end up, we'll say we end up with $20,000, and let's say, and I know it'd be a little bit more than that, but if we actually put in 287 instead of 286.66, but we make 60 payments of 287. This ends up with 2780 in free money. $2,780 is pure free money, purely from interest. Because 60 times 287 is 17,220. All right, a little bit of investment vocabulary here. When you're depositing money in a bank account, you're making a cash investment. Accounts interest rate guarantees a certain percent increase in your investment called return. So the return on your investment, right? There's other kind of investments that are riskier besides savings accounts with the banks and so on. So stocks have some risk, bonds, but they also have higher payout. So investors purchase stock, which are shares of ownership in the company. For example, if a company has 1,000,000 shares, and if you own 20,000 out of the million, right? 20,000 out of 1,000,000, you have 2% ownership in that company if you purchase 20,000 of their shares. If you buy or sell stocks, you're a trader, you're trading. Stocks are traded on the stock exchange. There's two ways to make money in stocks. So first of all, let's say you buy stock for the value of the stock today is $50, and in 5 years you sell it for $75. Then you have capital gains on that, right? The investment is worth more. It's kind of like with your house. If you sell your house in X amount of years, well, you don't have a capital gains tax, but you made money on it, right? So you can make money on your stock value, right? That's your capital gains, and then there's capital gains tax if it's a taxable investment. While you own the stock, the company distributes all or part of its profits to shareholders as dividends. So here's the other way you can make money is a lot of companies will give like quarterly dividends. So depending on how much money or how much of the ownership in that company you have, let's say maybe they pay out 10% per share, right, that you own, and so they pay you that quarterly or whatever. Okay, those dividends. It's similar to like a savings account where they're just paying you interest every month, right? It's kind of like that, but it's based on how much ownership you have in the company and how much they decide to kick out in dividends. All right, bonds. So bonds, um, that's where you're lending your money to the company, and then that company is guaranteeing you an interest rate. Okay, so um, bonds are a commitment from a company to pay the price an investor pays for the bond at the time of purchase, called face value, along with interest payments. So they'll pay you back your amount plus interest, right? Because they're borrowing your money to do something with it. A listing of all investments that a person holds is called a financial portfolio. So your portfolio might consist of stocks, bonds, and mutual funds, and savings accounts, all that. Okay. Most financial advisors recommend a diversified portfolio so that you can reduce your risk. Right. Of course, that all depends on how old you are, the amount of risk that you should be willing to take. Daily newspapers and online services give current stock prices and other information about stocks. Here's uh, some information on the stock ticker. There's a 52-week high on there. There's a 52-week low. So that's the highest price at which that stock traded. Lowest price it traded in the last year. Stock just refers to the company name. There's a symbol for that. The dividend refers to the dividends paid per share that they paid last year. Yield percent is given as well as the volume in hundreds for the sale that they did. So the HI high and then the low will stand for the highest price that it traded yesterday. So the goes up and down throughout the day, and then there's a closing price as well. Net change stands for the net change as that it closed and how it compared to the previous day's close. Price to earnings ratio. This is in essence the amount an investor is willing to invest in order to earn $1 in earnings from that company. Okay, so if your PE ratio is, I don't know, 75, then you got to invest $75 to earn $1 for that year. Okay. All right, let's see if we can read a stock table here. Use a stock table for Disney. Answer the following questions. Let's start with this one. What are the high and low prices for the past 52 weeks? So I'm like, well, the last year, that was the highest that it was traded at, or that it ever closed at during the year. That's the lowest value of the stock over that year. Here's the stock's name, Disney. And then, oops, let's keep going here. B, it asks us, what was the dividend paid for a share? By the way, this stock name, there's the symbol for it, DIS. So you just DIS if you're trading. There's the dividend. So this is saying is paid 21 cents per share last year in dividends. So for example, if you own 3,000 shares, last year they paid you 3,000 times 21 cents. They paid you 630 extra dollars just in dividend money. Okay. The yield percent. So the yield percent right here. That's the percentage to give investors an annual return of their dividends. So for Disney, it's 0.6%. Right. So right, they made $630. So I was like, it's like it's equivalent to 0.6% if it was like in a savings account. That's what Disney paid. So volume. So yesterday it looked like Disney paid 115, or I'm sorry, had this much trading occur. So 11,590,000 because it's that one times 100. It's volume in hundreds. That's how many shares were traded yesterday. As it was trading yesterday, the lowest it ever got traded at was 32.5. The highest it ever got traded at was 32.5. The lowest was 31.25. At the end of the day, it closed at this price, 32.5. When the stock exchange stays there until next morning. All right, the net change right here, notice there's nothing there. So the if the close was 32.5, the previous day's close was also 32.5, so there was no net change. If the previous day's close was 33.5 and then it closed at 32.5, the net change would be down -1. Okay? All right, so for the H question, it says compute Disney's annual earnings per share. So annual earnings per share, take their closing price divided by the price to earnings ratio. Okay. So the closing price was 32.5 divided by 43, right? So in other words, you could buy a share for $32.50. So divided by 43. So each share would pay you 76 cents for the year. If you were to buy one share at 32.50, the price earnings ratio is telling you you're going to make 76 cents on that. That's what we think. Okay. Because again, the PE ratio is saying I got to invest $43 to make a buck. So if you only buy a share for 30, 32.50 is the value of one share, you're only making 76 cents on that. Okay. All right. Some other retirement savings accounts. A traditional IRA is in a savings plan, a government savings plan, allows you to set aside money for retirement. So in a traditional IRA, you can put your money in some like mutual funds or some different options that you'll have based on the financial company. But let's say you can invest in whatever you choose. So let's say you choose to invest in mutual funds, but you can do it pre-tax, traditional IRA. So you do not pay taxes on the money going in, but you'll pay taxes on the money coming out. Okay. That's a traditional IRA, and you can do that up to $6,000 per year. If you're under 50, you can do that $7,000 in total per year for 50 or older. And then you can make contributions without penalty after the age of 59 and a half. Okay. Roth IRA. Remember this one. Huge. Okay. Now you pay taxes on the money going in. So this is after tax money you make this contribution. You can still, it's the same amount. You can still put in $6,000, at least as of the year 2020. But all the money coming out is tax-free money coming out. Okay, that's a big deal. Like, let's say, for example, you start with nothing, but you make a payment 500 a month so that you're maxing it out. How much would you have at a rate of 10% if you did this, let's say, for 40 years? How much money are you gonna have? Well, let's do it. 500 bucks, 10%, starting with nothing up front, 500 bucks a month. How much you're going to have if you're making 10% on a collection of great mutual funds, like maybe a mutual fund that just tracks the S&P 500, which is average 10% compounded monthly. How much money do you have? You have $3,000,000, $162,039.79. $3,000,000 doing that for 40 years. Okay, and that's a big deal because that is tax-free money. You can take it all out in a year, and the government can't touch that money free after the age of 59 and a half years old. Roth IRA, big deal. Whoops. All right, employer-sponsored retirement plans. So oftentimes employers will try to use these to attract high-quality employees. So with a lot of professional jobs, high-paying jobs, they'll offer these to their employees, sorry. So 401k, 403b. The only difference is 401k is for the private market. Okay. Oh my gosh, I can't get this thing to work for me. 401ks are for the private market. 403bs are for your nonprofits, so universities, schools, that kind of stuff. Okay, but they work the exact same. It's just like a traditional IRA. It's pre-tax money, so the money going in is not taxed, but when you take it out after age 59 and a half, it is taxed at that time at whatever your tax rate is. Okay, but you can put in a ton of money. You can put in $19,500 every year, or if you're 50 or older, you can put in $26,000. So these are incredible savings accounts. You can still do your choice of investing in whatever you choose to invest in, be it the stock market or bonds or mutual funds, whatever. But the tax consequences are wonderful. Thanks so much for listening, and we will see you guys next time.